Welcome back to Stock Predictor. Today we're breaking down a critical question every dividend investor is asking right now. 7 dividend stocks just hit new lows. Is this a golden buy the dip opportunity or a warning sign to stay far away? Markets have been volatile, interest rates are still a big question mark, and dividend stocks that were once considered safe are now under serious pressure. So in this video we're going to walk through what's really happening, why these stocks are falling, and how smart investors should think about them before putting a single dollar to work. Let's start with the big picture. Dividend stocks usually fall into defensive categories: utilities, consumer staples, telecom, REITs, and energy. These companies are supposed to generate steady cash flow and pay consistent dividends. But when interest rates rise or economic uncertainty increases, these stocks can drop hard, especially if investors start questioning dividend safety or future growth. A new low doesn't automatically mean a great deal. Sometimes it means the market is pricing in real problems. The first dividend stock hitting new lows comes from the telecom sector. This space has been brutal. High debt levels, slow growth, and massive capital spending needs have scared investors away. When a telecom stock hits a new low while offering a high dividend yield, the key question isn't how big the yield is, it's whether the company can actually afford it. Look at free cash flow, not earnings. If free cash flow is shrinking while debt remains high, that dividend could be at risk, and the market usually sees this before retail investors do. The second stock on our list comes from the utility sector. Utilities are traditionally stable dividend payers, but rising interest rates are their worst enemy. Utilities carry heavy debt loads, and refinancing that debt at higher rates squeezes profits. If a utility stock is making new lows, you need to check two things: regulatory pressure and debt maturity schedules. If regulators are limiting rate increases while interest costs rise, margins get crushed. In that case, buying the dip too early can lock you into years of underperformance. Next up is a consumer staples company. This one surprises a lot of investors because consumer staples are supposed to be recession resistant, but inflation has changed the game. Higher input costs, weaker consumer demand, and pricing power limits are hurting margins. When a dividend-paying consumer staples stock hits a new low, ask yourself whether earnings are temporarily pressured or structurally declining. If sales volumes are falling consistently, not just quarter to quarter, that's not a dip, that's a trend. The fourth stock comes from the REIT sector, and REITs have been crushed across the board. Higher interest rates have pushed borrowing costs up and property values down. When a REIT hits a new low, dividend investors often get tempted by double-digit yields, but this is where many people make costly mistakes. REIT dividends depend on funds from operations, not traditional earnings. If FFO is declining and debt refinancing is coming up soon, that high yield could disappear fast through a dividend cut or dilution. Now let's talk about an energy dividend stock hitting new lows. Energy is a tricky one, because prices are cyclical. Oil and gas stocks can fall sharply even when dividends look safe. For energy dividend stocks, balance sheet strength is everything. If the company has low debt and disciplined capital spending, a new low could actually be an opportunity. But if the dividend is funded by borrowing or asset sales, that's a major red flag. Energy dividends should be paid from cash flow, not hope. The sixth stock is from the financial sector, banks and financial. Dividend stocks have faced serious pressure due to rate uncertainty and credit risk concerns. When a financial stock hits a new low, you need to look beyond the dividend yield and focus on loan quality. Rising defaults, weakening commercial real estate exposure, and declining net interest margins can all threaten future payouts. Dividends in this sector can look stable right up until the moment they're cut, so caution is critical. The seventh and final stock hitting new lows is an industrial dividend payer. Industrials are closely tied to economic cycles. When global growth slows, these stocks feel it fast. If an industrial dividend stock is hitting a new low, check order backlogs and forward guidance. If management is lowering expectations and demand is weakening, the dividend may be safe for now, but future growth could be limited, meaning your total return may suffer even if the payout continues. So how do you decide whether to buy the dip or stay away? Here's the framework smart dividend investors use. First, separate yield from safety. A high yield doesn't mean a good investment. Second, analyze cash flow. Dividends are paid in cash, not accounting profits. Third, evaluate debt. Rising rates punish over-leveraged companies. Fourth, look at dividend history. Companies that protect dividends at all costs usually communicate clearly about it. Fifth, consider opportunity cost. Tying money up in a weak dividend stock could mean missing better opportunities elsewhere. One of the biggest mistakes investors make is buying too early. Just because a stock hit a new low doesn't mean it can't go lower. Markets often overshoot in both directions. Patience is a powerful tool. Sometimes the best move is to wait for confirmation, stable cash flow, improving guidance, or at least a slowdown in selling pressure. Another key point is diversification. Never overload your portfolio with high-yield stocks from the same sector. Many dividend investors learned this lesson the hard way with telecoms and REITs. Spreading risk across sectors helps protect income when one area struggles. Let's also talk about dividend traps. A dividend trap is when a stock looks cheap and offers a high yield, but the underlying business is deteriorating. The yield rises only because the stock price is falling. Eventually the dividend gets cut, and the stock drops even more. Avoiding dividend traps is more important than chasing yield. Long-term income comes from sustainable businesses, not flashy payouts. On the flip side, there are times when buying the dip in dividend stocks pays off massively. This usually happens when the market is pricing in worst-case scenarios that don't materialize. Strong balance sheets, conservative payout ratios, and resilient demand are signs a dividend stock may recover over time, but this requires discipline and a long-term mindset. If you're a conservative income investor, it's okay to stay on the sidelines when uncertainty is high. Cash is a position. Waiting for clarity can protect both your capital and your confidence. If you're more aggressive, scaling in slowly rather than going all in at once can reduce risk. Buying in tranches allows you to average into positions without trying to time the exact bottom. The bottom line is this: 7 dividend stocks hitting new lows is a signal, not an automatic buy or sell. It's a signal to dig deeper, understand why the stock is falling, and decide whether the dividend is truly safe or just an illusion. Smart dividend investing isn't about reacting emotionally, it's about analyzing facts, managing risk, and thinking long-term. If you want more videos like this where we break down market moves, dividend opportunities, and income strategies in plain English, make sure to subscribe to Stock Predictor. Hit the like button if this video helped you, and comment below, are you buying the dip in dividend stocks right now, or are you staying away until the dust settles? Thanks for watching, and I'll see you in the next one.